Investing has been incredibly easy over the last 10 years. Thanks to the Fed falling asleep at the wheel, you could buy anything from stocks to homes and even Pokemon cards and make a profit.
What I call them? Fun coupons. See that?
With the Fed keeping the federal funds rate at zero for the better part of the last decade, this made borrowing money incredibly cheap, and borrowing money creates wealth. But now we're seeing the Fed reverse this, pressing Command Z and destroying wealth. This has sent stocks into chaos, but luckily, the way that I've been able to trade it, I've made over 80% this year since the beginning of the year, and the way that I did this was options trading. So in today's video, I'm going to be talking about the Fed's huge policy mistake, how they're going to fix it, and the game plan for traders and investors.
Well, Hector, here's the game plan. You're going to bring us 2 absolute martinis, and then precisely 7.5 minutes after that, you're going to bring us 2 more.
The majority opinion right now is that the Fed is doing too much too quickly, because right now the Fed is raising interest rates at a pace that we haven't seen since 1994. A year before I was born. And these huge interest rate hikes that the Fed is putting into the markets is causing recession fears, because whenever the Fed raises interest rates, this discourages borrowing, and borrowing is the creation of wealth, because companies need to borrow money in order to grow their business, and consumers need to borrow money like on credit cards, car loans, and home loans. Even Elizabeth Warren came out against the Fed and saying that the rate hikes could tip the economy into a recession.
You could actually tip this economy into recession. You know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that before you drive this economy off a cliff.
And the reason why the Fed is raising interest rates in the face of a recession is that right now we have high inflation. And this is a world problem. Here in the United States, we have 8.1% inflation according to the CPI, and this number probably comes in at a lower estimate because we know that food prices, home prices, and things that we actually need have really gone up by probably about 15 to 20%. And the world is experiencing this inflation as well. Across 10 of the most developed nations, there's an average inflation rate of 7.1%. And we haven't seen this kind of inflation since the 1970s and the 1980s. We'll talk about what caused the inflation later on, but right now the Fed's job is to stop this from happening, because a recession is a lot better than high inflation. If you look at countries like Argentina that have inflation in the rates of over 50%, those countries are going through a lot of chaos right now.
The South American country is grappling with inflation running at over 60%. Meanwhile, people from across the political spectrum gathered in the Plaza de Mayo in the Argentine capital. The protesters demand ceasing of the agreed-upon payments to the International Monetary Fund, given the South American country's increasing inflation and economic volatility.
As inflation ramps up, this sends more people into poverty. The people that are already living paycheck to paycheck can't afford to pay 5% extra next year or 50% extra. So the Fed needs to tame inflation by increasing interest rates, discouraging borrowing, and slowing down the economy. Hence, we need a recession. And the Fed has came out and specifically said that they are going to raise interest rates even if it causes a recession. So that's the majority opinion, that the Fed is doing too much too quickly. It's going to tip us into a recession, but this is necessary. But the minority opinion right now is that the Fed started too late.
And you're late.
What?
You're late.
And it was traffic.
Yeah, it's traffic.
Because back in 2021, the inflation rate was only just above 5%, versus this year, it's over 8%. And the thing about taming inflation, the idea is that you need to raise interest rates higher than the inflation rate to get real rates, or the difference between inflation and interest rates, below zero. So you need to discourage borrowing by making the interest rates higher than the current inflation rate. And this idea was coined by Paul Volcker back in the 1980s. During the 1970s and the 1980s, we had the oil embargo, which sparked inflation to over 15%. And then Paul Volcker took office in 1979, and he raised the federal funds rate to over 15%. This ended up nipping inflation in the bud, but then he ended up cutting the rate back down to under 10%, and inflation went right back up. After that, he decided, I'm done with this. And he raised the federal funds rate to over 20%, which was above the inflation rate. And this ended up killing inflation, sending it from 11% per year in 1981 down to 3% by 1983.
Did you do it?
Yes.
What did it cost?
But the problem is raising interest rates that high isn't really possible anymore. And the reason for this is because of the US national debt. Back in the 1970s and the 1980s, we had maybe $4 to $5 trillion in debt, and as of 2022, we have over $30 trillion in debt. So this means for every 1% that we increase our interest rate, we're paying an extra $300 billion a year in interest. And this is almost the size of the entire defense budget. So with the Fed raising rates, this makes borrowing more expensive, and if we were to raise rates to 20%, we'd be paying over $6 trillion a year in interest payments. The government spending over the last 10 years has been absolutely insane. We've actually doubled our national debt from $15 trillion in 2012 to again over $30 trillion today. And this was fueled by the favorable 0% interest rates. Everybody was spending money, even the government, and this ended up ballooning the national debt to where now we can't raise interest rates above the inflation rate in order to get rid of inflation.
Well, that's just great.
If we went to just above the core PCE inflation rate at 6.1%, we'd be paying over $1.8 trillion in interest payments. And this is where the minority opinion comes in, or my opinion. And the way that I'm thinking is that the Fed has been on autopilot for the last 10 years, keeping interest rates so low, creating mass speculation throughout the entire market. The price of everything has gone up, from homes to stocks, and again, even Pokemon cards, which is a bit ridiculous. Home prices, for example, on average, have gone up by 8% annually since 2012. And ever since 2011, we've only had 2 months where home prices fell. So everybody thought that home prices could only go up, and I think we created a bubble. This is already happening over in China, if you've been following that, and I think it could be likely to happen here in the United States. Nobody sees a bubble coming until it's too late, because bubbles are clear. But because of the increasing home prices over the last 10 years, we've seen houses double in price. Now we have a cost of living crisis. If you think about it,
think about what you'd think about.
What is your main expense? Whenever you're looking at your budget, it's probably going to be rent or mortgage. And second to that, it's probably going to be your energy bill or your grocery bill. And the thing is, the Fed actually excludes this information out of their core PCE, or their favorite inflation measure. So in reality, the inflation rate is probably above the core PCE at 6% and above the CPI at 8%. And everybody thinks that this inflation was a recent event, but like I said, home prices have been going up by 8% per year, and that's everybody's main living expense. So this is all fueled by the favorable 0% interest rates for the better part of the last decade, and now the Fed needs to correct that mistake. So here's how they're going to do it. According to the Fed's summary of economic projections, they're expecting interest rates to peak next year in 2023 between 4.4% and 4.9%. Again, the core PCE at the moment is 6%, so this is still below the inflation rate, and they expect this to tame inflation.
I don't think so.
I don't think so.
I don't think so.
I don't think so.
I'm more neutral on the situation. I think it'll stop inflation from continuing to go up, but I think that we need to raise the interest rates above inflation, and I'm not alone in this thinking. Ray Dalio, one of the largest hedge fund managers, said that the Fed probably needs to raise interest rates to something along the lines of 5 to 6%. I would probably err on the side of 6% because, again, core PCE is at 6%. But it's going to cost the government a lot of money in interest payments. But the Fed thinks that these higher interest rates will help inflation and bring inflation down from 6.3% currently down to 3.1% by the end of next year. And if they have the interest rates at 5%, then that would be able to curb inflation. It would just be slower versus if they were to just pull the Band-Aid off and do it now. But the kicker here is that they plan to maintain higher interest rates for longer. Their long-term projections for the next 6 to 10 years is to keep the federal funds rate between 2.3% and 3%. And we haven't seen the Fed hold interest rates above 2% for more than about 4 years. The last time this happened was back in 2016 to 2020, but then they cut the interest rates back to zero once COVID hit, because they thought that this was going to be the end of the world. So they stimulated the economy by dropping rates back to zero, again fueling a ton of speculation, and now their plans is to fix that by keeping interest rates higher for longer. And we haven't had the federal funds rate above 2% for more than 4 years, since between 2004 to 2008. And we know what happened after 2008.
Benny Klieger over at
Morgan is taking on some heavy losses in the bond department. Your ship might be taking on water. I'm jacked.
I'm jacked to the tits!
So right now we're transitioning from a decade of free and easy money from these 0% interest rates to likely a decade of pain if the Fed keeps their promise. But the last time that they said that they would keep interest rates above 2% was back in 2017. They kept interest rates above 2 for a few years, but then again, COVID hit. So barring any crazy world event, which seems unlikely right now, the Fed is probably going to keep their promise to keep interest rates higher for longer, discourage borrowing, and slow down the economy. These higher interest rates are going to make borrowing more expensive for companies that want to grow their business by taking out debt, and it's going to hurt the consumer because the interest rates on their credit cards are going to go up, and the next time that they go to buy a car, the interest rate is going to be higher, so they can't afford as much car, and the same thing happens with home loans. Overall, I think that these higher interest rates could slow down the economy significantly, but here's my game plan. Since the beginning of the year, I've already sold about half my stocks, and now my balance is around 50% cash, 20% options trading, and then 30% stocks now. And if you're looking to pick up stocks, then you need to find a company with high earnings power, a company in an industry that is growing a lot to where they're seeing more demand than they can keep up with. This is why Tesla makes a lot of sense for me.
To the moon!
Tesla has high pricing power right now, and the demand for electric vehicles is likely to go up over the next 5 to 10 years. If it follows the S-curve that we saw for smartphone adoption, then I think that we could reach probably about 80% penetration electric vehicles to new sales by the end of this decade in 2030. So in the meantime, demand is going to outstrip the amount that Tesla can supply, so they can keep their prices high. Their earnings per share is likely to stay high because of this, and they're going to be earning positive free cash flow, which is important. But the problem with Tesla is that it has a lagging effect, because the way that a bear market works is it starts out with small cap and speculative stocks. We saw the bear market start for small caps back in March of 2021. And then we saw that transition to mid caps, such as AMD, which was thought to have extreme earnings power over the next few years, because at the time we had a chip shortage, and because supply was lower than demand, just like electric vehicles right now, people thought that they would keep this high pricing power and their earnings per share would continue to grow. But now we're seeing the reverse. We're seeing an oversupply from these chip makers, which is bringing their earnings down.
I'm only burning my half.
So that was the second leg of the bear market, which was, again, mid caps and seculars, or stocks that are predicted to be hot for a few years. And then finally, the last leg of the bear market is mega cap companies. And the last two legs standing right now are Apple and Tesla. Apple has already fallen quite a bit since they scrapped their plans to increase production for the iPhone 14, and now Tesla is the last man standing. Tesla and Elon have these long-term rosy projections for the next 5, 10, 15, 20 years, and people aren't so interested in that long-term time frame whenever interest rates are so high. So I'm planning to sell a bit more of Tesla. I started this year with 75 shares. I sold maybe about half of that back in June, and I've been slowly selling out, basically reverse dollar cost averaging. I'm still planning to hold at least 30 shares probably by the end of this year, unless things start to get worse. If their earnings per share starts to drop, then that would be a sign for me to sell a bit more, and the rest of my money is going to be in cash and options. For options trading, I have about 20% balance to my total portfolio, with $10,000 in options trading versus my $60,000 total portfolio, and this has been making me a ton of money over the last couple of months. Whenever the stock market is extremely volatile like we're seeing right now, I typically earn more money with options trading. And October is historically the most volatile month, so I'm projecting that I'll probably earn more money next month than I did for September.
I'm me, I stay automatic. Money add then multiply.
But then after this, the volatility should start to wane down and my profits will probably drop. I'll probably have to find more strategies to make money when volatility is low. But that's the great thing about options trading is there's so many different ways to trade. There's so many different strategies to choose from, whether for higher volatility or lower volatility, whether the stock market is going up or going down. And you can even bet on the stock market trading flat. You can use different timelines with different expiration dates. And overall, there's just a ton of options whenever it comes to options trading. So I'm planning to keep my options balance around 20% of my portfolio. And then the rest of this is going to be in cash for the crash. I'm expecting stocks to fall probably another 20 to 30% back to what we saw in 2018, whenever SPY was between $290 at the very top to $240 at the bottom. Somewhere in that range, I might consider buying, but it really depends on how things in the economy are going at that point.
Oh my God! Okay, it's happening. Everybody stay calm. What's the procedure, everyone? What's the procedure? Stay calm!
2018 levels just make sense to me though, with the Fed's projection for the interest rate at that time, and with interest rates above where they were back then, there could be even more downside risk. So I'm going to start buying stocks between 290 and 240 for SPY, and probably start to dollar cost average then versus starting now. That way I can get a discount. Now, obviously, this is complete speculation and it's anybody's best guess as to where the stock market is going to go, but this just makes sense to me. So that's my plan for the markets right now. Hopefully you found this video useful. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.